over.
Okay. Hello, everyone, and welcome to the first TSCC Lunch and Learn. Today's topic is going to be about the tax increment financing districts, and we have Tony Barnes from Prosper Portland here to speak to us about that. I am Brittany Albiari. I'm the budget analyst with TSCC. I'm hosting this Lunch and Learn today. If there are any questions, I guess we can utilize the hand raise function just to give us a little shout out if you have a question to ask. And then Tony, I will turn it over to you.
Great. Thanks, Brittany.
Yeah.
Good afternoon, everyone. I'm Tony Barnes, CFO with Prosper Portland. I've been with the agency for quite a few years in different capacities, and happy to join you today to talk about TIF. For those who might have joined a TSCC training last January, this is going to be a more technically focused session. I'll talk a little bit about TIF 101 and some of the new TIF districts that are just starting, as well as I can talk a little bit about the housing set aside, which is tied to TIF districts as well. I heard that there might be some interest in that. I'll also be able to provide direction to some follow-up resources as needed. But with that, I can share my screen and get started if it sounds okay.
Sounds great. Thank you.
And I'm not a heavy Zoom user, so please bear with me here. Sure I got the right one. Okay, can you see my screen okay?
Yes, I can see that.
Great. Okay, so as I mentioned, we'll talk a little bit about Prosper Portland, TIF 101, spend a little time on the new TIF districts in Portland, housing set aside, and if we have time, we can talk about financial impact a little bit, something that we shared with council and other stakeholders as we moved through the process last year on the new districts. So a little background on Prosper.
We have a few people that can't see your screen right now.
If you can see it because you're hosting, Brittany,
Oh.
but the rest of us.
Let me see. Oh, I can enable that. I'm sorry, I'm not a typical host for Zoom. So,
I think you have to make Tony the host and you can
Yeah.
share the screen.
okay.
Or co-host would be fine too. In
Oh, yeah.
participant. Yeah.
Let me go ahead and do co-host. Okay. Now you should be able to share for everyone.
There we go.
Yay. Thank you,
Thanks,
everyone.
everyone.
Yeah, thanks.
So yeah, I mentioned we'll talk a little bit about Prosper, some TIF 101, new Portland districts, and housing set aside. So as background, Prosper Portland's the city's economic development and redevelopment agency. There's currently 12 districts. We call them tax increment districts. In the statute, it's still called urban renewal, but we really have moved forward with utilizing tax increment, talking about the tool, rather than the very old terminology of urban renewal going forward. I don't have a slide on the budget. I can share a link to the budget, but tax increment financing represents about 80 to 90% of the resources Prosper Portland utilizes for economic development. Other resources include city general fund allocations, as well as some revolving loan funds that do citywide economic development. Prosper Portland was established in the city charter, section 15 of the City of Portland Charter. It's a governing body. It's made up of 5 commissioners, executive director. We have several departments, including development, economic development departments that are more externally focused on delivering projects and programs. We have our own finance and administrative section, as well as legal, equity, policy, and communication sections as well. We have a lot of work on an ongoing basis with the mayor and city council. City council nominates and appoints commission members, as well as approves our annual budget. We work with city council and the mayor through the deputy city administrator in the community and economic development service area of the city. And we also coordinate very closely with the Portland Housing Bureau, they're also in the service area. As we'll talk about 45% of TIF dollars go to the affordable housing set aside, which I'll talk through the mechanics a little bit more to go through the process. So strategic alignment, three key areas that tie back to TIF districts and Prosper Portland. We're guided by Advanced Portland economic development strategy that was adopted in 2023, investing in traded sector industries to increase quality jobs and business growth, increasing access to capital for entrepreneurs and small businesses, fostering a vibrant central city, and neighborhood districts as well. We're also, as we look at TIF districts, tying this back to the housing production strategy that was adopted in, I think, 2024 for portable rental housing, large-scale development, property acquisition and rehabilitation, and gap financing for middle-income housing. So as we talk about new TIF districts, they tie back to these strategies. And of course, every TIF district has a TIF district plan that is adopted by council, by the board and council. They include district boundaries, long-term objectives for the district, includes the priorities for housing, economic development, and infrastructure, and investment priorities for the district. They're really guided by 5-year action plans, and I'll mention where we are in those processes for the next couple districts that are coming online. This map has kind of a complete overview of the city of Portland, both older districts, what we call sunsetting districts, and some of the newer districts. Shown in blue, dark blue, are the newer districts, which includes Lloyd Holiday, Sumner Park Roads, REA Columbia Corridor, the West Side District, and sorry, the lighter blue are the newer districts. So there's West Side, Columbia Corridor, Central East Side Corridor, Sumner Park Roads, REA Columbia Corridor, 82nd, and then we have Lentz is an older district. East 205 is a newer district. And then Interstate Northeast, an older district as well. As we go through this, I'll look at each one in more detail so you can get a sense of where they are in the district life cycle. Okay, so the next few slides focus on TIF 101. As background, the tax increment financing tool is a resource that can be invested in community priorities for physical improvements. It's not a new or increased tax. Funding comes from the growth of assessed value, incremental value within the district. So as this graph illustrates here, when a new district is formed, as part of that TIF district plan, a frozen base is identified. The frozen base is the tax assessed value of the district upon creation of the district. Over time, as assessed value grows in the district, that creates the tax increment, which will fund projects and programs. The tax increment dollars generated itself cannot be directly used for investment. It has to be converted to debt. So our practice is to work with the city's debt office to issue tax increment debt to fund the projects and programs. And the tax increment in turn pays off that debt over time. we'll talk about history of districts in more detail, but the growth here is made up of a couple things. One is the normal 3% maximum growth on taxable assessed value. And then also any new construction. So if there's new construction that's added to within the boundaries of a district, it'll be included as new taxable value that's part of the blue tax increment. In periods of low growth, new construction, sometimes the new 3% growth is the only new assessed value that's going. Over time, and this is a more recent legislative change, actually 2009, when TIF revenues equal 3% of the maximum indebtedness, 25% of the future growth goes back to the overlapping taxing jurisdictions. I'll illustrate this a little bit more in the next slide, the calculation, but this was put in place to help return some of that increased value later in a district back to the city, the county, and the school districts to help return the value a little bit sooner before district closes. However, when a district reaches the maximum indebtedness, 100% of that tax increment goes back to the city, the county, and the school districts. Pause there for a moment and see if there's any questions on the base calculation. Move on to the next one here. $12.5%. For is that the revenue sharing?
Sorry, yeah. I thought again, this is my limited understanding. I thought it was 10% is when you start sharing, and 12.5% is when everything over goes to the overlapping.
Oh, well, thanks for asking that. I believe this is the language in the statute here where TIF revenues when they equal 3% of the indebtedness.
Indebtedness, okay. Or
yeah, 25%. So maximum indebtedness. So every district has an established maximum indebtedness that's created when the plan is adopted. So so when TIF revenues equal 3% of whatever that maximum amount is, then 25% of the future growth at this point in time will start to be returned. But when it gets to 10% of the maximum indebtedness, it plateaus. So 100% of the future growth goes back to the taxing jurisdictions. So historically, before this was implemented in 2009, and this did not exist, 100% of the tax increment went to the TIF district. And what effect this has on the calculation over time is that the taxing jurisdictions get to share in that increased growth sooner, but it might take more time for the district to reach maximum indebtedness, to reach the end of the life of the district.
What is the indebtedness usually set at? Like,
yeah, thanks for that.
Like how
question.
that amount is come to?
Yeah, there's a calculation. Take a look at that in a moment. That changed, I think, in 2009. It set a specific requirement on the calculation. So the statute's listed as if a total frozen base is $50 million or less, the total maximum indebtedness may not exceed $50 million. However, if the total frozen base is more than 50 million, but less than or equal to 150 million, then the maximum indebtedness may not exceed 50 million plus 1/2 of the difference between 50 million and 150 million. Or C, if the total frozen base is greater than $150 million, the total maximum indebtedness may not exceed $100 million plus 35% of the amount over $150 million. So in short, this is really guided by what the frozen base is of the defined district. And that sets up the calculation for certain maximums of the total maximum indebtedness over time.
How much would be invested in that community based on how big it is? Right. Okay.
Right. So larger districts, and I think that's in all the cases of Prosper Portland and City of Portland's newer districts, they fall into, I think, that third category. They're larger categories, so it's taking that $150 million plus 35% of the frozen base as a limit. And so that was the upward kind of limit of total investment over the life of the district that was established in each plan. And I'll share in a few slides what those limits are for some of the new districts. And going back to the tax increment calculation, summarizing at a really high level, we have the combined tax district rates, so the overlapping taxing district rates for an established district. So City of Portland, Multnomah County, any school districts, community college, whatever overlapping districts there are within a district, that is what gets applied to calculate the tax increment. It's the permanent rate. I have here bond or levy rates if applicable. There's not very many cases of that in existence anymore. Any new districts, and I'll get to the legislative history on this in a moment, any new districts would be excluded from having bond or levy rates. It's only going to be the permanent rate for the overlapping taxing jurisdictions. So the tax rate, consolidated tax rate, is applied to that excess value for what is defined as used, and that's usually 100% of the tax increment, and that creates the tax increment revenue. That frozen base keeps going back to the city, the county, and the school districts. There are cases where excess value might not be used. Some of the increment might not be used, and that would go back to the taxing district. Or if there's revenue sharing. So once those revenue sharing targets are hit, then it's going to be applied to the taxing district. So that's the basic formula calculation that the assessor uses as they go through the annual allocation. So real quickly, what can TIF fund? It's really guided by physical improvements and related investments. So examples, Prosper Portland, loans and grants to renovate buildings or redevelop property, property acquisition and disposition by the city, affordable housing development, commercial tenanting, infrastructure, and then of course, project allocated in administration that can be allocated to projects, redevelop projects. What TIF cannot fund are things that we often really depend on, either revolving loan funds from the federal government or the City of Portland General Fund, fund things like workforce development programs, business technical assistance, or other non-physical rental or homeowner services. Our partner agency, the Portland Housing Bureau, implements. So for example, PHB is dependent upon City General Fund, community development block grant funds from the federal government, other citywide resources to implement those types of programs. Prosper Portland receives about $13 million in general fund annually from the last budget cycle. Those resources are highly critical to support workforce development, business technical assistance, and other programs throughout the city that really complement a lot of the TIF work. The way we see it is that it works hand in hand with TIF and other revolving loan programs to provide a braided funding approach towards economic development, both in workforce development, technical assistance, supporting small business, but also TIF capital projects and programs. Okay, a few moments on legislative changes since 1990. Of course, it all start with Measure 5. It limited property taxes based on real market value. At that time, it really limited the existing capacity of TIF districts, and many districts under levied when that was implemented because of the limits in place. The changes through Measure 47 and 50, which separated taxable assessed value from real market value, and it capped that growth on assessed value. As I mentioned earlier, that's part of the increment, capped it at 3%. It had the effect of reducing some potential displacement pressure because of the limits on property tax growth. However, as we've seen, that's only one part of the pressure that's occurred in displacement over the last 30 years. It established something called option 1, 2, and 3 districts. It provided any legacy districts at that time options on how to reach their plan objectives. The main difference was that option 3 allowed for districts to implement what's called a special levy. It was a citywide special levy so that a district could complete its plan if it was limited through the property tax changes. We had several examples of that: downtown waterfront, Oregon Convention Center, Airport Way, and South Park blocks. All districts are complete. The special levy was in place all the way up until 2 years ago, and it's no longer in place now. So that was a $15 million special levy. It was an extra property tax, but that has gone off the books now since those districts have paid off all their debt and they're complete. So there's no district option 3 districts anymore. They're all based off of what we call divide the taxes, or rate-based districts. It also established maximum indebtedness, so that term of what that maximum level of investment could be by a district, so it wasn't unlimited over time. In the 2000s, we saw a number of other changes. In 2003, following, I think it was the Shiloh court case, the itemization of urban renewal tax increment taxes paid by all property tax in the districts. What that meant is that it was clarified that all property accounts within the city of Portland would be apportioned and pay a portion of property taxes related to a district that existed within the city of Portland, even though that district was in just a certain part of the city. It also categorized tax increment taxes as general government and clarified that for Measure 5 purposes. So when in the property tax calculation process, the second step was applying the Measure 5 limitations, the real market test of general government maximum taxes and education maximum taxes. Tax increment or urban renewal taxes fall into that general government category. Prior to this specific amendment, it was, I think, split according to where the source of the tax district was in the overall calculation. In 2009, these are really critical amendments that happened. One, a limit on maximum indebtedness based on certain amendments that can be done. So a district could not be increased by more than 20% of maximum indebtedness or 20% acreage. And then also revenue sharing, as we talked about, establish triggers on when excess value is returned to the taxing districts. So all the districts that are in place now are operating under these different changes that went into effect. Finally, I'll mention in 2013, I think it was, there was voter-approved local option levies. Anything after 2013 is exempted from the TIF calculation. So I mentioned earlier that only the district's permanent rate is used for the newer districts. There's a few cases where local option levies and bonds were still in effect for older districts. But going forward for any new districts, that will not be the case. There's no tax increment generation from local option levies or bond levies, only the permanent rate. That had the impact of increasing taxes in order to generate the right local option levy amounts or bond amounts by including that in the calculation for tax increment. So going forward, that's no longer an issue.
Can I can I ask a follow-up to that?
Absolutely.
So for the local option levies, so say a school district passes a local option levy, does that mean that the they will get the full value of the levy after 2013?
Right. So there's for any new districts established and any new local option levies in place, those amounts will not be in the calculation for those new districts. And I'll illustrate where there's a couple, I think, legacy calculations in place for local option bonds as of last year, but those will be going away over time. Yeah.
Okay, sorry. I'm really struggling with all of this, so forgive me. So when you say it's exempted from the TIF calculation, does that mean the school district levy is no longer impacted by the sort of shifting over of tax revenues to TIF rather than the levy issuing district?
That's correct. Yeah,
Okay, thank you.
absolutely.
And bonds wouldn't, a bond wouldn't be counted as the indebtedness for the district? Or it's not, that's something separate.
A bond for the
Like like the school district bond, or like a bond in the TIF district, or a bond in the, say the parks go for another bond. Do those values, those additional tax values affect TIF districts at all?
not
Or are
for
those
any of
separate?
them. Yeah, not for
Okay.
any of the new districts.
Okay.
There's some legacy bonds or local option levies. I think it might be bonds. I'll address that on the next couple of slides. I think I have a slide that shows which districts are still impacted by that. But for any new district, there's going to be no sharing of or no impact of the local option levy or bond for those new districts whatsoever. So 100% of the local option levy or bond would be going to the district that originates that bond or local option levy. And before we get to that slide, here's some just a timeline of all the districts, both the ones that have been terminated, which includes some of those older option 3 districts that levy the special levy, downtown waterfront, South Park Blocks, Convention Center, River District, Fort Wayne. And then districts we call sunsetting, which are Central East Side, Glens Town Center, Interstate, and Willamette, where there's some TIF dollars we have left to invest in projects, but they're winding down. And I think in all cases here, they're no longer levying any tax increment revenue. There's no longer any divide the taxes or any increment being generated. Of older districts that were formed 20 or so years ago, North Macadam and Gateway are still collecting tax increment. North Macadam will be paying off all indebtedness this fiscal year, and Gateway will probably pay off by 2032. And then we have the newer districts, which I'll speak more of here in a few moments, that were adopted by City Council last year. Cully, 82nd, the Sumner Park Rose, Central East Side Corridor, West Side, Lloyd Holiday, East 205, that are new and collecting their tax increment, first year tax increment this year. So here's the slide I referenced that we can talk a little bit more about. I'm sorry, that's the next slide. This is showing TIF district assessed values and taxes last fiscal year. The tax assessor is working on creating the reports for this year. We'll be updating the 25-26 data here shortly. So this is looking at last year. So I mentioned the base frozen value for existing districts. There was Central East Side, Gateway, Interstate, Lentz, North Macadam, and the newer district, Cully. These were the established base frozen values. So this is the value where, when applied to the overlapping taxing jurisdictions, the taxes go back to those districts, the city, the county, and school districts. The excess value is the tax, creates the tax increment. Last year, it was Gateway, North Macadam, and Cully that generated excess value. Since Central East Side, Interstate, and Lentz Town Center had issued maximum indebtedness, these values were not used, and essentially this went back to the overlapping taxing jurisdictions too, so to the city, the county, and school districts. The generated taxes imposed, the actual tax increment for last year was just with Gateway, North Macadam, and Cully for a total of $38 million. And most of that's in North Macadam. And as I mentioned, this year is the final year of North Macadam. It'll be reaching maximum indebtedness. I think there's only about $5 million left to issue for North Macadam to complete the district. And then the value, 100% of the value the district completes would be released. Here's the chart that illustrates TIF revenues by taxing districts. And again, this is last fiscal year. So as I mentioned, there's the permanent rate, which is how all new districts will generate tax increment going forward. However, there are some older levies or bonds that are in place last year that generated some tax increment. And then the total that gets back to that $38 million. And if you go back to the prior slide, that was for Gateway, North Macadam, and Cully. So this illustrates that of that $38 million, $31 million was generated from the permanent rates for the city, the county, library district, Portland Public Schools, other school districts, community colleges. I'll take a note here. There is an extra element when it comes to education, since there is the state school funding formula in place. So this amount that is generated, say, by Portland Public Schools, that's an amount that is incorporated into the overall school funding formula. And so gets a portion of that is actually a loss based off of the average daily attendance and the school funding formula. So it's not a one-for-one impact to, say, Portland Public Schools, Park Rose, and David Douglas, because this taxes foregone gets really absorbed at the state level. So all the taxes from all the local jurisdictions, school districts go into the funding formula as well as all state general fund funding. And then it gets a portion back out based on the funding formula. So the actual loss, or if taxes foregone, is a number we've calculated to be much lower than what's shown here. But this is the amount that's generated for tax increment. For bonds and levies in place, $7 million was the amount generated. Most of that's related to I think the Portland Public Schools gap levy, as well as Metro and Morgan County. And some of these will be going away as districts expire and wind down, North Macadam being the primary one. So it'll be interesting. We'll generate this in the next few weeks as we get new data from the county assessor to show what the update looks like and what's coming from permanent rate versus any remaining bond levies. So I hope that provides a little bit more background. A lot of numbers here on the chart, but it gives you a sense of what apportionment there is between the permanent levy and what's being generated from the kind of legacy bonds or levies for the really two districts. It really comes down to Gateway and North Macadam. This will not apply to any new districts, including Cully, going forward. Kind of transition to new districts here. So a little background. Over the last couple of years, Prosper Portland Housing Bureau engaged with community, identify needs across the city, investment opportunities for different communities. And we identified what the limits are. Part of the tax increment limits that are in place are that a maximum of 15% of assessed value and 15% of the acreage of any district can be included in tax increment districts. So when looking at that, we worked with City Council at the time and our board and sought direction on how to proceed. And we identified what acreage and assessed value were available under the limits, and through our outreach with community and with City Council identified that we should allocate about 7,500 acres or $6 billion of assessed value in East Portland, and then 1,500 acres or and $3.8 billion of assessed value in Central City to explore putting in place new TIF districts. So these are the maximum values that really there was to identify across the city what could be put in place. There was an extensive TIF exploration and engagement process, including 95 steering committee and working group members, a lot of meetings, a lot of input and follow-up throughout the process across the city. And what resulted is the board and City Council adopting 6 ordinances that proposed approving 6 new TIF districts, 2 ordinances that approved amendments to existing Central East Side and Lens TIF districts, and also formally terminating older TIF districts. But also identified that the city administrator and Prosper Portland and the Portland Housing Bureau bring forward an updated housing set-aside policy and action plans on how we any recommendations on the housing set-aside policy. And that's due to come to council, I think, next November, about a year out. So for the 3 new East Portland TIF districts, Sumner Park Rose, there's about a total maximum indebtedness, total amount of investment that was established of $310 million. 82nd Avenue for $460 million, and East 205 for $770 million. And these were established using a 3% average assessed value growth. And we made certain assumptions about borrowing after year 5 and spacing that borrowing out over the next 30 years. We assume that there's going to be also a standard 45% housing set aside. Talk about that a little bit more in a second. This slide illustrates some investment amounts for affordable housing for these districts for 82nd Avenue, East 205, and Southern Park Roads. For affordable housing, economic and urban development, and infrastructure. So this was what was arrived at through the planning committees and included in adopted TIF district plans for each district. So they're the kind of the guiding principles of the plan, how the investments will be made over time. The next step, which I'll speak of in a few more slides, is creating the action plans, 5-year action plans that accompany this. And so that process is underway now. And we just had committee members appointed by City Council for these Portland districts, and we'll be bringing action plans to City Council in, I think, January, February timeframe. So the action plans are more refined investment plan of the initial TIF district plan. I kind of think of the investments in 3 different levels, the plan, 3 different levels. One, you have the TIF district plan, which sets up the guiding principles and the guiding categories and large dollar amounts. The next step is creating the action plan, which are 5-year increments that drill down a little bit farther and create more specific allocations. And finally, those action plans are built into our annual budget and 5-year forecast, and more specifically defined at the project level. And so we bring forward our budget to our board, to the TSCC, to City Council annually to illustrate those investments and show how they tie back to the action plans. For the new Central City districts, the West Side District is $800 million in maximum addendums. Lloyd Holiday at $290 million, and Central East Side corridor at $200 million. You can see here the old Central East Side District. This was part of the amendment package last year that council adopted to remove acreage in order to make room for some of the Central East Side, the new Central East Side corridor district. The amended Central East Side District just is wrapping up and has already issued all of its addendums and no longer levies any tax incentive. So the investments in Central City districts, again, categories of affordable housing, economic and urban development, infrastructure, public realm, allocated between West Side, Lloyd Holiday, and the Central East Side corridor. These are the planned high-level investment categories, and this again will be built out into action plans that will come before council and then incorporated to annual budgets. This slide illustrates really high-level potential outcomes at the end of 30 years. Units of affordable housing, number of small businesses served, dollar amounts going into small business, jobs supported, level of infrastructure investment in streets and public parks and other public assets. This is something that we'll come back to on a regular basis as we report out in conjunction with our partners. So the next slide or two talks about impacts. One of the questions that came up is, well, what does this mean for taxes foregone? And we looked a little bit at taxes foregone, the impact to the overlapping taxing jurisdictions. What this illustrates for the 6 new districts is how much for the city of Portland is estimated to be in taxes foregone over the life of those 6 new districts. In the first 10 years, we're estimating that's going to be about $71 million. That's the green in taxes foregone. But we compare that to what's coming back from the expiring districts. So from River District, Downtown Waterfront, Lentz, Central East Side, some of those terminated districts, about $448 million is coming back to the city of Portland over that time period. So that's a net of around $377 million. Important to note that all this forecast has already been built into the city of Portland budget and forecast, so it's accounted for as they've updated their forecasts. But we'd just like to show kind of a comparison of what the taxes foregone from the new districts are compared to what is coming back as from the terminated districts. Same for Multnomah County. Over the next 10 years, we estimate net taxes returned of around $358 million, about $68 million in taxes foregone from the new districts, but $426 million are coming back from the expiring and terminated districts. And again, like the city of Portland, I think these dollars are all accounted for in the county's budget and forecast as well. And circling back to my note around the state school fund for school districts, this illustrates the total impact we estimate for Reynolds, Park Rose, Dave Douglas, Centennial, Portland Public Schools, somewhere between $38 and $47 million over the 30-year period of the 6 districts, all 6 districts. So this number is quite a bit lower than the millions on other slides for the city and the county. And again, that's due to the state school fund and that funding being portioned out at the state level based on the state school funding formula. Basically, that the taxes foregone being absorbed at the state level. A lot of numbers here. Sorry for the detail, but trying to get a picture of where we are as of June 30th for all the amendments, all the terminated districts, plus all the new districts, and see where we are on that 15% citywide cap. Again, there's a 15% of citywide acreage limit and a 15% of citywide assessed value acreage limit. So putting it all together, all the old districts coming off the rolls, all the new districts being added, we're at just under 15% of the city's adjusted assessed value and just under 15% of the total city acreage with all the changes. So what this means is that there's not really a lot of capacity right now for any new TIF districts in the near future until other districts expire, reach maximum indebtedness and repay all indebtedness. But there is some opportunity for some slight adjustments here and there. I'm going to pause there before we get into, I think, housing set aside. Make a quick note that I think I mentioned already that for our new districts, we're doing action plan development right now. And we'll be planning to bring our action plans to the board and city council later this fiscal year in the winter.
Looks like we have a question from Rita.
Yeah.
Yeah, so my understanding, I think is my understanding, for some of the projects within these TIF districts, there are tax breaks. I mean, especially for things like housing. Can you talk about the interplay between tax breaks and the TIF increment?
Yeah, absolutely. So back to the slide here. So as a district starts into year 1, year 2 of its kind of life cycle, It'll pick up that 3% growth that naturally occurs on existing properties. However, if there's a new development and that new development, say has no tax breaks, no abatement, then 100% of that new assessed value helps add to this tax increment total. So it might accelerate this growth if a large new development comes into place. And when there's a large new development and a high amount of new taxable assessed value, that increases the amount of tax increment revenue, and in conjunction increases the amount of tax proceeds that can be reinvested into the district. So if there is a tax abatement on a project, then you would not see that tax increment from a new development. All of our districts right now, as far as the budget goes, we forecast that using a 3% on existing property. We are not forecasting using any assumptions around new growth. Over time, there definitely will be that new growth that impacts the growth and the timing of a district and the forecast for new resources. But we're not building a budget, and we're not building an initial forecast using that new growth. So the impact of any potential abatement doesn't have much of an impact on the initial forecast, but in reality, it will impact whether or not there's new tax increment from any development. Does that answer your question?
Well, yes and no. So let me be really blunt. Do tax abatements undermine the whole purpose of TIF districts?
Well, I think, that's a kind of there's a kind of a policy question in there. From a technical standpoint, I think for it, there's definitely the impact where you won't recognize the tax increment from a district project that's been abated, but there's other benefits related to that investment that's tied to the overall development of a district. So I don't think it can really be, I don't think it can be, I don't have an answer for you. That's just a clear answer for you. I think there's definitely technical impacts for the revenue, but I think it has to be taken into account for the overall purpose of the district and overall plan for the district. So all the tools need to be looked at together as kind of a coherent.
Would it be fair to say that there's a tension between these two mechanisms?
Yeah, I think there's always a tension, and I think there's just by the nature of that you won't receive tax increment from an abated project, but there's a broader, bigger question about what's happening in district planning and how those different tools work together. And I think potentially they work really well together if planned right. I mean, there's different tools that need to come together in an overall economic development and housing plan, and how you put those tools together. I think they can work together really well if done.
Okay, can I ask another question? And this is another blunt one. So you've talked a lot about the benefits of using TIF districts to promote development and growth. Can you talk about the downsides? So one of the downsides that I've seen posited is that using TIF districts will concentrate investments in particular areas, but might starve other areas of potential investments. So I mean, can you talk a little bit about the costs as well as the benefits?
Yeah, sure. I think it's really changed how we look at the tool, TIF as a tool over the last 20 years. And I'll try to put into the link here a study that was put together by Echo Northwest a couple years ago that really took a deep dive into some of the costs and benefits over time, especially over the last 20 years. It's a great resource to dig into that question. But what we've seen is that if you don't invest in community upfront, there are can be significant impacts in terms of displacement and other costs that are realized by, say, overinvesting in infrastructure and other initial investments first. And, that's examples we have of the South Auditorium project and the harm that was done with that district in the 60s, as well as other districts in Portland. The Interstate District, which was established in 2000 or 2001, heavily invested in infrastructure first, the yellow line, and several other investments. That district and that history, I think, really informed how we went about with a community-based model with Cully and the 6 new districts that prioritized investment in anti-displacement measures first to support the community and make sure that we bolster that district. So I think it's about how, right? And that's what we've identified through some of the look backs. But there's also, it's about the overall district plan that's put in place. So it's both the investment choices of the plan and as well as the timing of that plan, those investments in the plan. It's like multidimensional. Am I getting to your question there?
Yeah. Um, I I think I think I would like to see that link.
Yeah, absolutely. I'll if I don't put it in the chat here, I'll make sure that I send it over to Brittany and have that. Well, as well as some other resources that are helpful.
Okay, that'd be great. Thank you.
Just wanted to do a quick time check because we are approaching 1 p.m.
Oh,
So I know that flew by. Lots of interesting information. Did you just want to finish up your slides, Tony?
yeah, sure. I heard that there might be interest in the housing set aside, affordable housing set aside policy. So just real quickly, this is tied to TIF investments. It was originally established in 2006 as a 30% of TIF going to affordable housing. In 2012, it got changed, so it no longer includes any income coming back from investments, or it includes some allocations for administration. The big change was in 2015, where the set aside was changed to 45% minimum. But it depends on district. For example, in the Interstate District, the set aside 70%. Other districts, it's much lower. It's a process. We work with the Portland Housing Bureau to figure out how much is needed between set aside projects and non-set aside projects, economic development projects. We basically work on our budgets throughout the year together and make sure that we true up the set aside over time. So it's not exactly 45% of the dollars in every single year, but it might be lower in one year and higher in another, depending on the timing of capital projects. A lot of numbers here again, too. But just wanted to focus on the policy targets here. And the spent and budgeted from 2015 to 2033 kind of shows that 45% what is being invested over time. Some here is $413 million in affordable housing investments. Most of that, because of the 70%, is in the interstate district, which is starting to wind down. And then Lentz, North Macadam, and River District. Just a note here, this doesn't include the 6 new districts. I just talked about their investment plans for. So this number will grow by the dollars that's just starting to be planned out in those action plans for the 6 new districts. I think that's it. But happy to follow up on questions. There's a lot of information, and I just want to make sure that I can follow up on any questions that are out there.
Tony, this is Todd Burton. If I could ask you a question. With the new West Side District, and I think that's the name of it, correct?
Yes.
What are you seeing, or what is your crystal ball seeing in terms of even being able to generate tax increment out of that? Because you've got so many high-profile properties that are losing and sometimes possibly even falling below their assessed value.
Yeah, that's a great question. It's on all of our minds to see where first year increment, if there is increment, where it might land. So looking forward to reports coming out from the county assessor here very shortly, which will arrive on that. What we did when we budgeted for this first year, we used a 1% increment as a placeholder instead of a 3%, noting that there was a lot of changes working their way through the system on taxable assessed values. I do want to note that the boundaries of the West Side District do exclude a lot of larger properties, like it excludes the U.S. Bank Tower, the Big Pink.
Oh, it does. Okay.
And other larger commercial properties that might have some significant impacts. So it's going to be interesting. I think I think there's a good base. For example, it does include the boundaries for the U.S. Post Office site, Broadway Corridor project, which once it starts developing, we'll be working from a lower base as the site's being has been demolished and is now ready for development. So there's that dynamic, similar to what happened in North Macadam, where there was some older industrial land that was redeveloped and it was kind of a blank slate.
Are you seeing the same thing? Was it the Holiday Park District too? Do I have that name correct?
Yeah, Lloyd Holiday.
That's Lloyd Center. I mean, is there much value there that you could count on? Increment value, I mean?
Yeah, that's a good question too. It's we used a discounted value for budgeting that. We'll see where things start out here in the next few weeks. But the value is a bit more than just the Lloyd Center itself. So there's some opportunity for some growth there.
And I guess I'll have to ask you about Cully, since you've had a couple of years with Cully. I know that was a district when we met with you 2 years ago that you had just what's been your experience there?
Yeah, it's been coming in right around 3% growth in the last 2 years.
So you are able to make some of the investments you want to in the Cully neighborhood?
Yeah, it's going to be slow. The action plan is just being adopted as well here. So Increment is starting out in just helping with the planning process and the initial investment process. We can't leverage any tax increment into long-term bonds until after year 5, based on the city's debt policy, until we have a good track history on what the increment is to support any to leverage that to get any larger amounts of proceeds to invest. So the total amount of investment over the next 5 years will be somewhat limited. And as I mentioned with the investment plan and the timing of investment, there'll probably be more focus based on smaller programmatic tools to support the community in that interim period. But the action plan still being finalized with stakeholders, and that's that'll be coming out.
Thank you.
Well, great. Thank you, Tony. Do we have any more last minute questions? Anybody want to squeeze in? All right. Well, thank you everybody for joining us. And thank you so much, Tony, for taking time out of your day to come host and present with us today. It was very helpful information. Thank you.
Yeah, helpful. Really glad to be here. And if I can follow up on any questions, happy to do so. If there's anything that left you wondering and like, I really need that explained better, please reach out to me and I'd be happy to kind of dig into it a little bit more with you. And in the meantime, I'll send out some resources that I think will be helpful to complement the conversation.
That sounds great. And I'll get those forwarded out too.
We'll see you in June.
Yep.
Yes.
Thanks, everyone. Thanks, Brittany.
Thanks, everybody. Have a great day.
See you later.